Welcome to this week's edition of Weigh the Options. Weigh the Options is a video series where I take a look at 5 potential options trades that I'm thinking about for this week. Now, do note that Weigh the Options is a members-only video series where members of the channel get access to the video immediately. Non-members have to wait 1 week before the video is publicly available. So please consider becoming a member of the channel. Click the join button to become a member. So this week in the market, it's all about earnings because we are in earnings season, and this week you have hundreds of companies reporting, including many of the largest, most important companies. You're going to have Meta, Microsoft, and Google, and Apple, and Amazon all reporting this week, and then you've got many smaller companies as well. One of the ones that is reporting before the bell tomorrow, so I need to put on a trade today, is SOFI. So let's take a quick look at SOFI. So SOFI, wow, it's had a huge run up here in the last year or so. You can see currently trading around $30 a share. I remember trading this thing when it was like $5 a share, right? So this thing has really exploded in price in the last couple of years. And IV rank of 34. Let's check the IVX. The IVX in the 53-day cycle, 80%. Extremely good implied volatility. Now, what would I want to do? Well, typically when I see something with really high implied volatility, I want to sell both sides of the trade. I want to do a strangle. But because of the strength of this, because it's been kind of a runaway train to one side, I think what I'm going to do is a ratioed strangle. So instead of, doing even puts and calls, let's go sell the 12 delta put and maybe do the 13 delta call. But let's go and double up the put. All right, we'll do twice as many puts versus the call to give ourselves a little bit of bullish slant here. So in this case, I'm going to sell 2 of the 22 strike puts, that's the 12 delta, and 1 44 strike call at the 13 delta. I'm going to receive a credit of $166 on a buying power reduction of only $524. Excellent risk reward because of the excellent implied volatility, right? Now the pop on the trade, the probability of profit is 78%. Now that's for if you hold it to expiration, your chance of winning at expiration is 78%. I would never hold a trade to expiration, not a short options trade. I'm going to take profit always at 50% should I hit it. And my probability of hitting 50% max profit at some point over the life of this trade is 90%, right? Really high probability. So I love the trade as far as risk reward, as far as the probabilities, all signs point to go on this trade. So I'm going to go ahead and ship that thing. Let's go ahead, click the review and send. I did not get filled immediately. Mid price is 169. That's the price I put in. Let's tick it down 1 penny. Let's give up 1 cent to see if we get filled at 168. 168 did not get filled, but I'm not going to tick it down because I do think the market is open right now. I think the market will move around a little bit. I will eventually get filled at that price. If I don't, I'll tick it down another penny or two. Next up, Google. Let's take a look at Google. I actually haven't traded Google in a while because Google has just been crazy strong, right? Google has an IV rank right now of 42. It has an IVX in the 53-day cycle of 38%. So not the most high IV tech stock, Google, but that's fine. What would I do in Google? Well, because of the huge run up in Google, where, back in April, it was trading at $140 a share, and now it's trading at $265 a share, right? So that's crazy. That's almost doubled in price in like 7 or 8 months. What would I do here? Well, for me, I want to define my risk a little bit. I think I'll do an iron condor. Let's see what we can get on an iron condor. I'm going to sell the 17 delta put and then buy the put $5 below. You're going to get 80 cents credit for that. That's really good on the put side. So the call side, probably going to have to lean in a little bit. Let's go 21 delta for the short call and buy the call $5 above. And we receive another like 77 cents for that. So yeah, that's perfect because I want to receive somewhere around 150 for the credit. I'm receiving 154 credit on a buying power reduction or a max loss in this case, which is the same on a defined risk trade. So I'm risking about 343 to make 157. So that's excellent. That's what I want, about a 2-to-1 ratio for those on a defined risk spread. So all signs point to go on this. Let's put in a price of 160 to see if I get filled on that. I do not. The mid price is somewhere closer to 157. So let's tick it down to 158. See if that gets filled. It does not, but kind of like the SOFI trade, I'm going to let that sit and work. The market is open. Market may move around a little bit, and if I don't eventually get triggered in this, I will tick these down and get filled later. Another mega cap tech stock that reports this week, Meta reports after the bell on Wednesday. So I probably wouldn't put this on today, but Meta has had a nice little run up, obviously, in recent years, but it's been trading in a range here recently. Actually showed some weakness about a month ago, right? Where it had 2 or 3 weeks where it seemed like it just had nothing but down days. Because of that, and I do think Meta long term is still a bullish play. I think what I'll do Wednesday afternoon for earnings, I'll probably do the 53-day cycle, which has an IVX of 38%. Probably be bullish. I'm going to put on a put credit spread. If I was doing an example put credit spread for today, I'd go maybe to the 30 delta, sell that put, and then go $5 below, buy that put, and receive my usual 155 credit on a buying power reduction of about 345. Again, that's the kind of ratio I typically want for defined risk spread trades. I want to risk about 2 to make 1, so this trade fits that criteria. If you take a look at the probability of profit on this sort of put credit spread, pop is 65%, and that's typical. If you risk 2 to make 1, as far as risk reward, you're typically going to have a pop around 65 to 70%. P50 numbers a little higher because you're always increasing your odds of winning on a trade if you take profits early. So the P50 number is 78%. So again, pretty good probability of profit on this trade as long as you manage at 50%. Another interesting earnings play for this week is CMG, which is Chipotle. It's the burrito place, right? Chipotle Mexican Grill. And right now it's trading at $41 a share. Wow, this thing's really beaten up because I remember it being a much higher price stock. It was trading, at $66 a share, basically at the beginning of the year. So it's really, really beaten up. A really good IV rank of 63, IVX of 45%. That's really good for a restaurant, right? So a little fast food chain. So for me, I definitely want to go sell some puts, right? I think that's the smart play. I wouldn't mind doing both sides of the trade either because of the IVX. Maybe do the 15 delta put, the 14 delta call, that's the 35 put and the 50 call for 103 credit, buying power reduction of 411, really good risk reward. Pop is 76%, P50 92%. All signs point to go on that. Now I wouldn't do that today. CMG reports earnings after the bell on the 29th, so after the bell on Wednesday. So I'll wait till Wednesday afternoon, but that's what I'm thinking. If I wanted to lean a little bit more bullish, because again, the stock is so beaten up, maybe I do my classic 2 puts versus 1 call. So 2 of the 15 delta puts versus 1 15 delta call. Now I get a 162 credit on a buying power reduction of 761. Still same pop, same P50 number. Bigger credit, a little bit of a bigger buying power reduction. But again, if you want to make the trade a little bigger and also lean a little more bullish rather than neutral, you could do 2 puts versus 1 call. And then finally, I don't typically do these kinds of trades on camera or look at these kinds of stocks, but let's take a look at one of the big meme stocks, BE, Bloom Energy. You look at its stock chart, this has meme stock written all over it. This is something that's very dangerous to trade. It's not something I would typically recommend trading, or I wouldn't recommend trading it in an irresponsible way. We're going to trade it in a responsible way though. It reports after the bell on the 28th. So that is after the bell tomorrow. Well, I'll put this trade on tomorrow, but when I see something like this that has gone from, $17 a share or so to $126 a share at one point, now trading at $110 a share. This thing could come crashing back down at some point. I'm not saying it's going to do that on earnings, but for me, I don't typically buy options all that often, but I love buying a put, right? So it's trading at 110. Let's go buy a put for about $2. Maybe the 13 delta put here is trading around 177. That's the 88.5 put. So we would need the stock to fall, well, to cover the cost of the debit plus the strike we pick. We would need the stock to fall about $30. Now, could this thing fall from 110 to about $85 on earnings? Well, if you look at the chart, That's not a huge drop. You know, it's be right here where it would have to gap down, which it's seen those kinds of gap ups here in recent weeks as well. So surely it can make the same kind of move down, right? Really high IV, 215%. You don't see IV like that ever. Like this, again, you cannot and do not get suckered with this kind of high IV and go sell puts or sell calls in this thing. It's way, way too dangerous. I would seriously fear the puts on this. I know a lot of times with meme stocks, it's the call side you fear, but this thing's already seen such a big run up. I think a lot of the buyers are already in, and the real risk here is this thing come crashing down in a big way. And I don't mind playing a lotto ticket style play because that's what this is. This is a lottery ticket. I'm willing to spend $200 knowing that 95% of the time it's probably not going to work out. But 5% of the time it could work out, and in a big way where I could turn that $200 into a couple of $1,000, because I mean the thing could fall from 110 to 50, right? Again, most stocks you would say that's impossible, but with this kind of stock, it's certainly something to consider. Don't go risk a huge amount of money on something like this. Never go buy a whole bunch of long calls or long puts on some directional play, some lottery ticket kind of play. But if you want to do it small when the opportunity is there, or when you have a strong assumption, and for me, when I see stocks like this, you know what? I think it's fun, right? It's fun. I'm going to spend a couple $100 on that long put, and we'll see what happens after it reports on Tuesday. So there you have it. That's this week's edition of Weigh the Option. Again, Weigh the Options is publicly available right away for members of the channel. Non-members have to wait a week, so please consider becoming a member of the channel. Click the join button. It's only $5 a month, and it does help support the work I do here on this channel. Peace, guys.